You think your paycheck sits in a bank vault. It doesn't. Your balance isn't a pile of cash. It's a promise. If everyone asked for cash today, most banks couldn't pay. That sounds like a scam until you see what a deposit really is. This video answers one question, no tips, no predictions. If banks don't store your money, what exactly is a deposit? Open your banking app. That number feels solid, like weight. But there's no shelf in a vault with your name on it. A deposit is an IOU. The bank owes you that amount on demand. IOU means I owe you. A claim you can pass to someone else. That's why a card swipe works. Sellers accept the bank's promise. So your deposit is real, but it's real like a ticket is real. It works because everyone agrees the ticket will be honored. And the moment people stop believing, the magic disappears. That's the first shock. Money can be social before it's physical. Not because people are naive, because systems need shared belief. Now here's the story most of us were taught. Banks take deposits, store them, then lend them out. Savings go in. Loans come out. Simple. Comforting. It feels like a warehouse model. Piles in, piles out. But that story can't explain modern banking at scale. Because lending often happens first, and the deposit appears second. That sounds backwards. So let's slow it down. Because this one reversal changes how you see the whole economy. What follows is the cleanest version of the mechanism. When a bank makes a loan, it creates two entries at once. Entry 1 is an asset. Something owed to the bank. Asset means a thing you're owed, expected to be repaid. Entry 2 is a liability. Something the bank owes you. Liability means a debt. A promise the bank must honor. So the loan creates a new deposit balance in your account. You didn't hand them that money yesterday. It shows up as credit. That's the twist. Deposits don't fund loans. Loans create deposits. If that feels uncomfortable, good, your mental model just upgraded. Because deposits are not stored money. They're created promises. So banks aren't money warehouses. They're licensed credit creators inside a rule-bound system. Licensed matters, because trust needs a gatekeeper. And that raises the scary question. Can banks create infinite money with a keyboard? No, because the keyboard is chained to constraints. 3 locks decide how far credit creation can go. If you understand these locks, the system stops feeling mystical. And you stop blaming individuals for what incentives designed. Lock 1 is capital. Capital is the bank's loss-absorbing buffer. Think of it like a shock absorber, not a pile of spendable cash. It's what stands between bad loans and bank failure. If borrowers don't repay, capital takes the hit first. Too little capital means one bad wave can sink the bank. So, risky lending is not just risky, it's expensive to survive. That's why banks can't spam loans forever and stay alive. Even a profitable bank can be fragile if losses arrive fast enough. Lock 2 is liquidity and settlement. Liquidity means being able to pay, on time, without scrambling. It's not about net worth. It's about timing. Settlement means the final, between banks, payment behind the scenes. When you pay someone at another bank, your bank must settle. Your app updates instantly. But the system still has to square up. That settling often uses reserves. Reserves are balances banks hold at the central bank. They're used to pay other banks and clear the system's IOUs. So your swipe is simple, but the plumbing behind it is not. If a bank can't settle, trust snaps fast because promises fail. Lock 3 is regulation and risk limits. Rules decide which assets count, how much capital is required, and when. Stress tests ask, what happens if jobs fall and defaults rise? And funding isn't free. Banks pay interest to get stable funding. So lending is always a trade-off. Profit versus survival constraints. No villains required. Incentives plus limits explain most outcomes. And those limits change over time, which changes money over time. Now zoom out, because this is the part people miss. Most everyday money isn't physical cash. It's private bank credit deposit IOUs we all treat as spendable. Cash is government money. Deposits are bank money. Claims on banks. 2 layers, 1 wallet, 1 grocery run. Different foundations. And most days, you never have to notice the difference. Until a stress hits, and suddenly, promises get questioned. Quick gut check. When you picture your balance, do you picture cash? Or do you picture a promise that works because everyone plays along? If you had to label your bank balance in one word, what would it be? Drop it in the comments. Cash, claim, or promise? Because your answer reveals the story you've been living inside. That's why money printing isn't only a government story. Credit creation expands spending power. Credit contraction removes it. So booms and slowdowns can be credit stories wearing other costumes. When credit expands, the economy feels easier to breathe in. When credit contracts, the economy feels tight without warning. Sales slow, hiring slows, projects get canceled. Not because everyone suddenly became irrational, because the system changed the availability and price of promises. And the price of promises is the cost of money in disguise. It's why the same paycheck can feel different in different years. This is also why bank runs are not madness. A run is a logic test. Can IOUs convert to cash on demand? Everyone tries to convert at once, and the conversion bottleneck appears. Promises are liquid, until the crowd needs the same exit door. Liquid means easy to spend or convert without taking a loss. In stress, liquidity becomes scarce, and the price of liquidity rises. Then the system reacts. Rules tighten, standards shift, lending slows. Second-order effect. Behavior adapts to avoid the next freeze. Products change. Risk moves. The plumbing gets reinforced where it broke, and the system becomes more conservative until it forgets the last pain. So here's the reframe that makes the whole thing click. Money isn't just a thing. It's a relationship backed by a system. Your deposit is a relationship. You hold a claim on your bank. You can transfer that claim to others, and society accepts it. That acceptance is infrastructure. Rules, enforcement, and credibility. If you remember one line, make it this. A bank deposit is an IOU you can spend. Not cash in a box. Not bills in a drawer. A claim. And once you see deposits as claims, you see power differently. Because whoever controls claims shapes what counts as money. So here's a better question than, where is my money stored? When was the last time you noticed you were living on promises? And if this clicked, say what line changed your view one sentence only. I read the comments because they show what the system hides in plain sight. You'll notice patterns in other parts of life once you name this one. Which means the real question isn't, where is my money stored? The real question is, why do we treat these promises as real? What makes an IOU money instead of just a private note? Because promises need a backstop. Settlement, credibility, and trust. And once you see that, you start noticing the system everywhere.